Welcome everyone to DT Vector. So today we have alongside someone who's not just tracking the region biggest real estate deals, he is shaping them. Michal Soták. Michal is partner and head of capital markets at Cushman and Wakefield for the Czech Republic and Slovakia. In this episode, we'll dive into investors' psychology for this year. We'll talk about the return of the office, and we'll talk about how the fund strategy are evolving for a new cycle. Let's get onto it. So, Michal, thanks for being part of this podcast. And what is your outlook for the real estate investment across Central and Eastern Europe in this year and for the next year?
Thank you again. First of all, thank you for inviting me and thank you for having me on your podcast. Very, very exciting to be part of it. And good question. Obviously, the question that everybody is asking. From my point of view, what I see is that we definitely have much more money coming into the real estate sector, particularly from Czech funds, but not only from Czech funds. We can definitely see a return to certain level of confidence in the real estate sector across all the Central and Eastern European countries. Just as a quick comparison, in 2023, especially in Czech, the sector was losing money. So the Czech open-ended funds were losing quite a substantial sums of money every month because people were withdrawing the money from real estate funds and putting them into money market. Money market back then was very attractive. This has completely reversed in 24 and in 25, mostly because the interest rates in Czech crowns went down, as well as in Europe. And people had to think again about, what are the assets that will make them money in the future, and ultimately they shifted their funds from money market back to real estate, and that is what influences the sentiment in a very significant way. We can talk about the details of various subsectors of real estate, but when you have, particularly in Czech, whole segment of real estate funds raising tens of millions of euro of equity every month, they simply ultimately have to buy some buildings, and it will simply ultimately create positive pressure on pricing. So that is the number one factor that influences the environment in which we operate and what is happening on the market. In addition to that, what we are also seeing here are positive developments on the occupational markets, particularly in offices. Obviously, COVID has changed the paradigm in which offices operate. Coming to the office at 9 and leaving at 5 is no longer a dogma. People look at offices much more selectively, the users, the office employees, and that created a lot of uncertainty around whether offices as such will be viable going forward. But what we are seeing now is that it is becoming clear which parts of the office market will be functional and will be attractive to office employees and which won't. And that decrease in the level of uncertainty means that investors can now quantify the risk and can start buying offices again. So those would be, I would say, the two main factors that I would describe going forward: much more money in the system and a more positive sentiment towards offices. There are obviously other developments on the market, but those two are absolutely key.
Mm-hmm. So we can understand that the confidence is building. That's right.
The confidence, specifically in office sector, is returning, and the confidence in the other parts of the real estate market, I would say, has remained the same. If you look at retail, obviously during COVID, a big chunk of the retail market was closed because of the COVID prevention measures. Particularly shopping centers suffered a lot, and there has been concerns whether shopping centers will survive this situation. But they came back, and they came back stronger than everybody expected. Now, the turnover performance of shopping centers is in an excellent shape. But that is a development that has been happening over the last 2 years. It's not a new development of 2025. So the confidence in that part of the market has already been strong.
Mm-hmm. And how has the investor behavior evolved in this first 6 months?
If you look at the CEE countries, and to have a very quick overview, Czech Republic completely dominated by local money. 80% plus of the liquidity Czech funds on the Czech market. Poland has a nice mix of money coming into the country. You see Czech investors in Poland, you see Polish investors, you see Swedish investors, you see British value-add investors, or generally I would say Western value-add investors. Slovakia again dominated by Czech and Slovak money. Hungary dominated by local money, but most of it are not funds, but private individuals or groups. If you look at those four countries, and apologies for not having deep knowledge of the Romanian market, so I can't fully comment on that, but those are the four countries that I am in touch with. Again, the driving dynamic is because there is so much money coming from the Czech funds, it puts pressure on all the four countries. Because if those funds can't find appropriate product in Czech Republic, they will logically look abroad, and as the first stop, they will generally choose Poland. So the fact that we have record levels of funds coming into Czech real estate structures, it simply means that we see the sellers that could not sell since 2019 putting their product on the market. We see positive pressure on pricing. We see yields going down across the board, but particularly in offices, as I mentioned. And we see the Czech institutional investors thinking about what is their next move. And as I said, very likely their next move is buying properties in Poland. That has defined the market in the last 6 months.
I don't know exactly the market here in Romania, but I hope this, let's say, positivity turns. If we have, let's say, the political help these days, we have a struggle here in Romania. Maybe some money will get to Romania also. Which asset classes are seeing the most transactions?
I just wanted to say that Romania definitely should be the next frontier, and given the strong economic underpinning of the country, and then a very positive story of economic growth of Romania, together with strong fundamentals, but particularly from a distance, I see that industrial sector in Romania is improving. I assume that it should be the next target for Central European investors. And you were asking which sectors see the most activity. Yeah.
And we have some urbanistic challenges also, because some Romanian developers and investors will look. We have some challenges in, let's say, the big cities. So that at least didn't help our economy, to put it like that.
Understood. And apologies, your question was?
Okay, so I was asking which asset classes are seeing the most traction?
As I said, there is definitely a backlog of owners of office product across particularly Czech and Poland, but to an extent also in Hungary, who simply want to exit the market in a strategic way. If you look at German investors that own office buildings in Prague or in Warsaw, or some of them also in Budapest, they wanted to leave those markets for a while now. And they couldn't, simply because there was no liquidity for office projects. They will, and that also includes Korean investors who bought a huge amount of office product in 2019. Their 5-year business plans obviously ran out in 2024, and they logically want to finally exit the buildings that they bought back at that period of time. All of these sellers will find the market to be in a very different shape now. They will find the liquidity they've been looking for. They will probably also find the pricing that is satisfactory for them. So my main expectation is that we will have a wave of office disposals, particularly, as I said, in Prague, but also in Polish cities, Warsaw primarily, and potentially also in Hungary, in Budapest. And that will be a dynamic and a factor that will probably be the driving force behind the whole market. We will still see transactions in the shopping center segment. There will be, again, strategic exits of various owners of big shopping centers, be it German funds owning shopping centers in Czech, be it various types of money owning shopping centers in Poland. They will still exit. We have already seen many of shopping center disposals in Czech. We have sold at the beginning of the year Atrium Flora, last year Arkady Pankráč, both very sizable projects. The liquidity, which is again particularly Czech funds buying the shopping centers in Czech, will go also into Poland. So we will definitely see retail activity in Poland as well. But my estimate is that this will not be as significant as the activity in the office sector. Where I expect that we will see less activity than before is industrial. Industrial is becoming challenging because the money raised for industrial in the West has that wave of money, that wall of money has stopped to an extent. There is a lot of value add money for industrial, but we don't have that much value add industrial product in Czech and in Poland. So I don't think the industrial transactional volumes will be as significant as they were in the past few years. We have, as an example, sold Contra portfolio in Czech and Slovakia to Blackstone, 500 million euro deal. We simply don't have the product that would be of similar scale and of similar level of attraction to investors that we can transact again.
Mhm. So, from what I understand, we can see interest in the office deals. What's the story behind that, and how are the rents evolving?
If I talk specifically about Prague, which obviously is the market I know the best, Prague has been in office sector very homogeneous market. Out of town offices and the city center offices, their rents were not very different. I would say 10 years ago, the rents in edge of town locations were 15 euro, in the city center 19 euro. What has happened during COVID is that there was a clear differentiation between the attractive offices, which are in, I would call it, cool urban locations in the city center of Prague, where the employees actually want to go every day, and between the locations which are not as attractive for employees, which are on the outskirts of the city. And the rents have diverged, and you can get an office for 13 euro at the outskirts of Prague, but the offices in the city center, the rents went up from the 19 to probably currently 35 euro is a fair reflection of where the market is. And also, if you simply walk through those office buildings, you can see that most of the workstations in the not attractive locations are empty, whilst in the sexy submarkets such as Karlin in Prague, the office buildings are full of employees. And investors simply follow that dynamic. So their interest is obviously in the locations that are long-term sustainable, that are attractive for employees. And there is a very limited amount of product in those sexy submarkets, as I said, in those cool urban locations. And they are fighting very hard for those assets. And the pricing has moved, I would say, over the last year from, let's say, 7% as a general yield level for good offices in Prague to below 6% currently, which is a very big shift in the last 12 months.
Mm-hmm. You were talking a little bit about how the capital flows across the region. If you have more details, or if you can identify maybe a winner, if it could be a winner in the region, where would you put all the money?
Well, winner in terms of volume is very simple. As I said, the of Czech real estate funds, which are open-ended and have retail distribution, that means that they are being sold to everyday people who send, thousands and maybe tens of thousands of crowns to those funds regularly. Those are the funds that completely dominate the market, and not only the Czech market, but dominate also the Slovak market and have a massive influence over the Polish market. To put some numbers behind that sector, by my estimate, is raising 150 million euro of equity a month currently in Czech. So it can do deals worth of 4 billion euro every year in Czech, whilst the available product in Czech is probably between 1.5 and 2.5 billion. So the remaining approximately 2 billion, these funds have to spend that money elsewhere, and it will probably be in Poland, or a big chunk of that will be in Poland. So if you look at Polish capital market sector, which transacts, let's say, 6 billion euro worth of product every year on average, if 2 billion of that is Czech funds, then they will be 1/3 of the money in Poland, which is a very significant portion. So the main dynamic in Central Europe, Czech being an exporter of the capital, and Poland is the country where you can find product at sensible pricing, and that in a very simple terms, summarizes where the market is currently.
Don't want to get into political discussions, but do you think the political changes across this region could change those flows?
Obviously, the outcome of the elections in Poland helped Poland significantly. Poland is now seen as an attractive country, not only for Czech funds, but for Western investors as well. And I actually do expect that when the Western capital starts coming back, when those institutions will have inflows again, be it Germans or Swedish investors, the main country that they will target will be Poland, not Czech. When it comes to Czech, Slovakia, Hungary, any positive political changes, or in case of Czech, continuation of the current situation will obviously be positive, but it's difficult to predict, although I'm not a political analyst, therefore I don't want to comment on that too much. But having a government that has a Western orientation and targets stability and predictability of the economic sector is definitely a plus that can significantly move the needle on the real estate market.
Okay, talking a little bit about tech, because we're, let's say, more tech oriented in that part. We know more about, on our part, more about tech than the financial market. Where does tech and data sit in today's capital market?
There is, I would say, a general sentiment that says we should, as a sector, and particularly when it comes to areas such as property management or project management, that means labor-heavy areas with low margins, there's general sentiment that we should become more efficient as a sector and more automated and more sophisticated. And we see elements of that happening. We see our clients and us adopting software such as Yardi or iRooms. We see a pressure on unification of how we store and present data. But at the same time, it is very often very difficult to, in practical terms, adopt tech that is not generic. We all use Excel, and the fantastic advantage of Excel is that there is zero barrier to entry to it. Everybody can use it, everybody can understand it, everybody knows Excel from school. And therefore, taking a different tech than a simple Excel and implementing it across a company or across a wider part of the market means that you are incurring very significant costs upfront. You're losing probably a lot of man hours to adapt to the new tech. And the benefits of that adoption are very often not completely clear. And therefore, on theoretical level, everybody wants to adopt tech, but on practical level, the adoption of a sophisticated technology is very piecemeal and very slow and very selective. I would say one area of the business that I do where we see a very strong unification of technology is data rooms. So when we are already in a deal, when we are in the DD phase, everybody now uses a sophisticated electronic VDR platform with Q&A module. It's usually Sterling, but Imprima is also there, plus Drooms and others. But there is a clear market standard that every deal has to include a sophisticated electronic VDR. But outside of that, I don't think there is a universal adoption of technology in areas such as management, as I mentioned, or project management. And I don't think that this will change in the near future, because if you look at, as I mentioned, if you look at who are the investors, who are the future owners of stock across Central Europe, those are local companies, and they don't have any particular pressure to adopt a uniform technology because they usually operate only in very few countries. And it might not be operationally efficient for them to invest significant amounts of money into a complicated tech that they will ultimately not really fully utilize.
Yeah, I was discussing these days with Dirk Pelling, that is a co-founder to PropTech Association. And he has the same feeling. He lives between the PropTech startups and so on, but probably we need some standards, some open standards at the European Union level to have these technologies translated like an Excel, to be easy to use and not to be captive in one solution that one startup or big tech company is offering in the market. But I was curious how let's say the investors are seeing that, because in our part where we're doing the implementation, we know that how much can the technology do and can improve the let's say the life of a construction or a manager, but it's more to grow on that part, and maybe it's are the standards that should be improved. Okay.
What can change the tech adoption across the board is AI, obviously. Everybody is now used to AI and is using AI tools for everyday work. Particularly, for me, one of the things that I do is hire competent junior people into my team, and they usually already come with an AI-informed background to the job. And if the AI can operate with complex technology so that the human doesn't have to learn the complex technology, then it can actually speed up adoption of uniformed database solutions. I think that is something that can significantly help us in the future.
Yeah, for sure. And for, let's say, our domain, we need to have a standard way of doing things from the design phase, from the, let's say, the cadastre till the end of the construction, because there you add the layers to all the information that you can use when operating a building or selling it, and to have someone to ask the chat for the building how sustainability looks like, or ACG metrics, or to set up a, let's say, a digital twin for that. But we need that information, and we need a universal way of doing of building, basically design and building our constructions. Getting back to the to founding, what trends are you observing in fund strategy and capital raising right now?
That is obviously a very complex topic, but I would say one key factor that I see is that when it comes to open-ended funds, and again, I will be using the Czech example because it's closest to me. If you think about the business of a real estate fund, it has two sides. One of them is they have to buy and manage buildings, and potentially also sell them at some point. But the other, and I would argue probably more important element of their business, is how do they manage their distribution channels? Big funds usually sell themselves either via a network of independent financial advisors or via a network of bank branches. So we have typically either bank-backed funds like Reiko, for example, or we have funds that are backed by groups of financial advisors like Tragia or Investica. And the way the fund manages their distribution network is absolutely critical for its fundraising ability and therefore for its ability to be successful. To give you an example, if you buy a building, you will get a cash return, let's say 5-6% from the building, and you can probably assume that the building's value will grow every year, let's say by 2, 3, 4%. So you can get in total a 10% return from the building. That's your asset side. Now your liability side, what your investors want from you. Your investors on the street will typically want 6% return from you. So you have a building with 10% return and you have to give 6% to investors. So we have 4% to work with. And now, how much of that will you pay yourself as a fund manager, and how much of that will you pay to the distribution channel as fees for raising the money? And that is a very difficult question. And if you pay too little to the distribution channel, you will not raise money. If you pay too much, it will hurt the performance actually of your portfolio, and it will hurt the performance of your fund management company. And balancing that together with obviously buying the right buildings and managing them well is a very, very difficult task, particularly when there are so many funds as there are now in the Czech Republic. And I think doing that business right will be the skill that will be absolutely critical for the future success of the Czech funds and of the funds in CEE in general. And that is a big topic that I don't think is being spoken about enough.
Mm-hmm.
And also, I would like to say, I don't have any smart answers to that question. I think it's simply a very complex and a difficult task.
Mm-hmm. What risks do you see in the market in the next 1 or 2 years?
I think the big risk is the big risk will come either from the investment market or from the occupational markets. On the investment market, I think the risk is that because of the amount of money being raised and because of the competition between funds for product, the pricing of the assets will move too quickly, and they will simply become overpriced compared to a fair and sustainable level. And we can already, as I mentioned, the shift in pricing of offices was so dramatic in such a short time that it is possible that at least some of the deals that the buyers will do now and in the next 18 months will be problematic potentially going in the future from a long-term perspective. So there is definitely a potential risk on the investment market. The other risk is what will happen to the occupational markets. I don't think there will be an issue on the retail market because there is no new supply. No one is building new shopping centers. The existing shopping centers perform well. I don't see what can potentially go wrong there. I also don't see a huge risk on the office side. When you look at offices, as I mentioned, we don't know which ones will work and which ones will not work. And again, no one is building new offices because it's simply not economically viable. Therefore, I think that the office occupational market will only improve slightly over time. But when you look at other sectors such as industrial or retail parks, there is quite substantial supply in Czech and especially in Poland. And it is not very clear whether the tenant demand for those buildings will be sufficient to cover that supply. And therefore, the performance of these sectors is a question. And if someone invests heavily into, let's say, retail park segment, and it turns out that that segment is not viable, that can obviously create a potential problem. And so those are the two main risks. I would say the risk on the occupational market side is probably bigger than the one on the investment market side.
Taking back to let's say personal note, and because we build buildings, we live in buildings, we rent buildings, but maybe for some of them we like, or we're getting attached with them. What's the last building or urban space you walked into and thought, that's the kind of deal I want to work on?
I mean, many, as I said, in Czech Republic, you have a lot of money and not that much product. So doing deals here is in that sense easy. And in that sense, I like a lot of buildings. A lot of buildings are sellable and are interesting. Shopping centers, when I spoke about the shopping center deals that happened over the last 2 years, as I mentioned, we sold Arkady Pankrats to Clegia on behalf of GCT. I've known Arkady Pankrats for a very long time, it being a big shopping center in Prague. And it was very clear from the very beginning that this will be an attractive asset that people will simply like. Nice, very busy shopping center with a very simple layout that's sitting on 2 metro stops, 2 metro lines in the inner city of Prague. It's very obvious it's going to be an attractive product. So I really like that project from the very beginning, and we have successfully disposed of that. Another element or another popular area that I like walking through is Karlin, which is the most popular office submarket of Prague with 0 vacancy. And what is interesting and what is exceptional about Karlin is how well it combines public space with street retail, residences and offices into a mix that is very sustainable, that is very busy during the work week as well as during the weekend. And any office building in that submarket will simply be attractive to investors because it is a cool urban location. So transacting anything in Karlin is always a pleasure for me, and I've done that fortunately many times.
Okay, what's the one myth about the CEE real estate market that you wish would go away?
I think there are several, but probably a key myth that I would like to go away is that the CEE markets are somehow less sophisticated and less transparent than the Western ones. And actually, I think the opposite is true because our markets have largely developed after year 2000. So they have largely been built actually during our active careers potentially, and definitely in an environment where people already tracked data, maybe in Excel, maybe not in a sophisticated software, but at least in Excel. And therefore, when it comes to tracking of the modern stock, be it in Czech, Poland, Slovakia, Hungary, and I'm sure Romania will be similar, we actually have much better data here than we have in Germany or France or UK, where the markets have developed over the last 50, maybe 100 years. So our markets are actually very well covered in terms of data and in terms of how much we understand them. And in that sense, they are very transparent. Also, the level of professionalism on the market, definitely in Czech and in Poland, and I assume it's going to be very similar in Romania as well, is very high. The whole ecosystem of the buyers, the sellers, the advisors is very sophisticated. And in terms of transparency and sophistication, we are, I would say, on the same level as our Western counterparts.
That's a great myth busted. So
Thank you.
that's our perspective also. So that's pretty encouraging. Talking about a little bit more about the future, what asset class will define the next investment cycle that no one is watching?
Very difficult to find an asset class that no one is watching, because as I said, there isn't that much product, especially in Czech, and there is a lot of transparency on the market, so everybody's watching every asset class. And therefore, I don't think there is any particular part of the market that is invisible or underappreciated, or where you can find hidden value. I think the hidden value in the future will be, as I mentioned before, in how the funds will manage their distribution channels, which has kind of nothing to do with real estate, but actually everything to do with real estate, and it's something that's going to completely define how our future will look like. And if those funds do manage their distribution channels well and find a sustainable, long-term sustainable model how to raise money and deploy it, the sector will be successful. If we end up in a problem where the funds overpay for certain assets or structure their cooperation with distribution channels in a way that is too expensive and too complicated, we might end up in a situation where some of the funds fail, or there will be a scandal that will hurt the reputation of the whole sector. So that part of the market, which is not the part related to buildings directly, but related to finances, will be the one that will define the future of the sector in CE.
Because you know a lot, you're in this space and you have so many great results. Maybe somebody younger will watch this podcast and will learn at least something from you. But what advice would you give to your younger self?
My advice to my younger self that actually I took when I was my younger self is real estate is a very local business and also a very complex business. If you think about the building, that building obviously is a physical object that has to be constructed in some way. It can be described in Excel or in any other more sophisticated technological system. There are contracts signed with the tenants of that building. The building sits in is recorded in a cadastre. It gets energy from somewhere. So there are many aspects to the real estate business, which range from technical to commercial to legal to tax related issues to legal stuff. And people who will learn all the areas and will understand how those areas interact with buildings and with the whole real estate ecosystem will be the ones who will be successful. Because understanding only one part, for example, only leasing or only financing or only valuation, can make you successful in a very specific part of the real estate sector or real estate business as such. But bringing it all together is where you can significantly add value and where you can get ahead of all your peers. Because the sector is influenced by factors coming from all the various directions. So this is the advice that I would give to everyone. And this is also something that I have followed. And one of my biggest strengths and advantages on the market is that it's difficult to fool me because I understand all the various aspects of the business. Or I think that I do.
Mm-hmm. And what skill do you think has served you the best across banking, private equity, and real estate?
There are many skills that are very useful, and I don't want to discount any of them. But one particular tool/skill that I think is very useful is to be able to translate all your thinking into a cash flow model. It is one thing to instinctively believe something. It is one thing to hear something from others and then talk about it again. But the completely different thing is if you take all the information about real estate project, input it into Excel, turn it into a proper financial model, and then formalize your thinking and quantify it, that can actually guide you in a much better way than just talking about topics. So being able to do financial modeling, which is actually something that I learned at Citigroup in an investment bank, is a huge advantage because it turns your vague thinking into something that you can quantify precisely, and then you can give people specific advice. You can give your clients specific advice.
In a funny note, do you use the mouse when working in Excel?
I do use a mouse. I think a mouse is absolutely critical. Working with touchpad is extremely inefficient. So yes,
Oh.
so having a notebook and a mouse and an Excel is the key combination of tools that you need.
Mhm. I've seen some guys, and I've seen some contests about working in Excel without the mouse, and it was crazy for me. So that is why I've asked that. And if we're talking about, let's say, principles, what's one principle you'd want a young capital market analyst to never compromise on?
Well, that's a tough question. I don't have any specific answer to that. I don't think there is a one overriding principle. I would say, as I mentioned before, I mean, be explicit, quantify your thinking in an Excel, in cash flow, as I mentioned, but also then don't avoid learning new skills and understanding new areas. So if someone sends you a contract, read it and try to understand it, and if there are legal elements in it that you don't understand, look them up, ask someone else, ask a lawyer if you can ask a lawyer. Try to learn all the various aspects of the business you are in. Also, when it comes to construction, I think it was very useful, extremely useful for me to understand technical elements of real estate business and understand construction related knowledge. So don't be shy to understand it. I mean, ultimately, you're dealing with complicated physical buildings, complicated physical things that cost tens of millions of euros to build, and understanding how they were built and why they were built the way they were is actually very useful. So don't put yourself in a box and think of yourself only as an analyst. Think of yourself as someone who is learning everything he or she can about real estate business.
When do you think that a deal was truly worth doing?
You mean when I believe buying a building is worth it specifically?
Yeah.
I think the critical thing is you want a location that is unique in some way, and typically a unique location means it's a location that can't be replicated because it's close to the city center or it's on a critical transportation hub. It's close to public transport, so I think that is absolutely crucial. The other thing is that you want a building that has logical and flexible layout. You don't want odd shapes, you don't want circles, you don't want waves, you want rectangles. You want something regular that you can work with, and then you can also adapt in the future. An excellent example is my department store here in Prague, next door office in Quadrio, which was built in the 70s as a department store, and it was refurbished over the last 2 years into a modern entertainment center. And one of the key reasons why that happened was because the layout of the building was a regular 2,000 square floor plate. So you want the flexible layout. You want a viable sector, obviously. You generally don't want to buy, 10-story shopping center because they don't work. And you want visibility on the potential technical issues with the building. You can fix an old building with money, but if you're getting yourself into a uncertain situation and you end up spending 60 million euro on fixing the building instead of 20, then you're going to have a problem. But if you know what you're getting yourself into, you can obviously calculate it in the financial model, as I mentioned. So those key points would be critical for a deal. And an overarching point, which kind of goes without saying, but I want to emphasize it maybe. You want to buy properties in cities that have positive demographic dynamic. You don't want to buy properties in cities that are dying out. You want to buy them in cities that are growing. And for example, in Czech, there aren't that many cities that are growing. It's probably only Prague, Brno, Ostrava, and Plzeň. And therefore, that already very much limits the scope that you should be focused on.
Okay, that was a very insightful conversation. Thank you, Michal.
Thank you.
I have one more questions for the, let's say, for the next episodes. I like to learn a lot, and I like to expand, not to learn only in my area, in my industry. Who are you watching in this space of real estate? What voices do you like to hear? Maybe someone that could be in a future Data Vector episode.
That's a very good question that off the top of my head, it's very difficult for me to answer. I'll have to think about it. Look, we have some very strong individuals in our own business, such as Jeff Olson, our CEE head of capital markets, or Pavel Partyka in Poland, who are great. Some of our competitors are also excellent. I would specifically mention Sean Doyle from CBRE in Poland. But then, if you look at the top Czech funds, be it Reiko, Tragia, or Mint, Jirka Horak from Reiko, Tomáš Trčka from Tragia, and Sebastian Dajanovský from Mint are absolutely worth talking to, because these are the guys who deploy the money and they know what they are doing, and they've been successful for many, many years on this market. So those would be the names that I would mention.
Perfect. Thank you once again, Michal. Very insightful. Good luck in this period. Until next time, let's all be great for all the things be great for you. Thank you once again.
Thank you very much, Eugen. Thank you for inviting me. Goodbye.
Goodbye. Until next time, I'm Eugen Ursu, and this was Data Vector. Bye bye. Ciao.